Welcome back to our series on navigating the path to home ownership. I'm Duane Buziak, a senior mortgage loan officer. Ever feel like mortgage rates are a secret code only a few people understand? One day they're up, the next they're down, and you're left wondering, how do I get the best one for me? If that sounds familiar, you're in the right place. Today, we're tackling a topic that often feels like a mysterious, ever-shifting force: mortgage rates. Many homebuyers find themselves puzzled by how these rates are determined, why they fluctuate, and most importantly, how to secure the best one for their situation. Understanding mortgage rates isn't just about knowing a number, it's about grasping how this single figure profoundly impacts your monthly mortgage payment and ultimately the total cost of your home over its lifetime. A difference of even half a percentage point can translate into tens of thousands of dollars over 30 years. My goal today is to pull back the curtain, demystify what influences mortgage rates, and arm you with the knowledge and strategies to optimize your own rate. As a seasoned mortgage professional, I've guided countless individuals through the intricacies of mortgage financing. My role is to help you not only understand what affects rates, but also how to leverage that knowledge to your advantage. Let's dive in and unlock the secrets of mortgage rates. What exactly is a mortgage rate? At its core, your mortgage rate is simply the cost of borrowing money to buy a home. It's the interest percentage charged by a lender on the principal loan amount. This rate, combined with the loan term, like 15 or 30 years, determines how much interest you'll pay over the life of the loan and significantly impacts your monthly mortgage payment. There are two primary types of mortgage rates: fixed-rate mortgage. With a fixed-rate mortgage, your interest rate remains the same for the entire life of the loan. This means your principal and interest payment will never change, providing predictability and stability in your monthly housing costs. This is often preferred by those who plan to stay in their home for a long time and value consistent payments, regardless of market fluctuations. It offers peace of mind, knowing exactly what your core housing expense will be for decades. Adjustable rate mortgage, ARM. An ARM starts with an initial fixed interest rate for a set period, e.g. 3, 5, 7, or 10 years. After this initial period, the interest rate adjusts periodically, typically annually, based on a specific market index, like the Secured Overnight Financing Rate, or SOAR. While ARMs often offer a lower initial interest rate compared to fixed-rate mortgages, there's a risk that your rate and monthly payments could increase significantly once the adjustment period begins. ARMs can be suitable for borrowers who plan to sell or refinance before the fixed period ends, or who are comfortable with potential payment fluctuations and understand the associated risks. They can be a strategic choice for those with shorter-term home ownership plans. It's also critical to distinguish between the interest rate and the annual percentage rate, APR. The interest rate is simply the cost of borrowing the principal. The APR, however, gives you a more complete picture of the total cost of the loan, as it includes not only the interest rate, but also certain closing costs and fees charged by the lender, like points, broker fees, or administrative charges. When comparing loan offers, always look at the APR to understand the true overall cost. A lower interest rate might look appealing, but if the APR is much higher due to excessive fees, it might not be the best deal. The APR helps you compare apples to apples across different loan offers. Major economic factors influencing mortgage rates. Mortgage rates are dynamic, constantly responding to a complex interplay of economic forces. Unlike other consumer loans that might track the Federal Reserve's direct rate changes, long-term mortgage rates are largely influenced by the bond market, specifically the market for mortgage-backed securities, MBS. Understanding these forces is key to anticipating rate movements. Here are the primary economic factors that drive these fluctuations. Inflation is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. For mortgage, lenders, and investors, inflation is a significant concern. If inflation is expected to rise, the fixed payments they receive from a mortgage loan in the future will be worth less than they are today. To compensate for this anticipated loss in purchasing power, lenders demand higher interest rates on new mortgages. Think of it this way: if your dollar buys less tomorrow, a lender wants to make sure the dollars you pay back are worth at least as much as the dollars they lend today. Therefore, expectations about future inflation are a key driver of mortgage rates. When inflation fears rise, so do rates. Conversely, when inflation seems under control or is expected to fall, rates tend to be more stable or even decline. Economic data like the Consumer Price Index, CPI, and Producer Price Index, PPI, are closely watched for inflation signals. Federal Reserve Policy. The Fed funds rate and quantitative easing tightening. While the Federal Reserve does not directly set long-term mortgage rates, its monetary policies have a profound indirect impact. Fed funds rate. This is the target interest rate set by the Federal Open Market Committee, FOMC, for overnight lending between banks. While it directly influences short-term interest rates like credit card rates or auto loans, its connection to long-term mortgage rates is less direct but still significant. A higher Fed funds rate signals the Fed's intent to tighten monetary policy, which can lead to higher long-term rates as well, as the overall cost of money in the economy increases. Quantitative easing and quantitative tightening, QT. This is where the Fed's influence on mortgage rates becomes more direct and powerful. During periods of economic distress, like the 2008 financial crisis or the COVID-19 pandemic, the Fed engages in QE by buying large quantities of government bonds and mortgage-backed securities, MBS, from the open market. This increases the supply of MBS in the market, which puts upward pressure on MBS yields and, consequently, mortgage rates. Understanding the Fed's stance on QE/QT is crucial for anticipating broader rate movements. U.S. Treasury yields, particularly the 10-year Treasury. Mortgage rates are most closely correlated with the yield on the 10-year U.S. Treasury note. Both mortgage-backed securities and 10-year Treasury notes are long-term, relatively low-risk investments that compete for investor capital. When the yield on the 10-year Treasury rises, meaning its price falls, investors demand a higher yield for mortgage-backed securities as well, causing mortgage rates to increase. The 10-year Treasury is seen as a benchmark for many long-term interest rates, making it a key indicator to watch. Bond market activity, driven by investor sentiment and economic outlook, directly translates into movements in Treasury yields and, subsequently, mortgage rates. Economic growth and employment data. A strong economy, characterized by robust GDP. Growth and low unemployment generally signals higher inflation expectations and a greater demand for credit. When people are working, earning, and spending, prices tend to rise, prompting lenders to demand higher mortgage rates to offset inflation's impact and to capitalize on increased demand. Key economic reports like the monthly jobs report, non-farm, payrolls, gross domestic product, GDP figures, retail sales, and consumer confidence indexes are closely watched by bond traders and can trigger immediate shifts in mortgage rates. Conversely, signs of a weakening economy, rising unemployment, or a slowdown in consumer spending can lead to expectations of lower inflation and potentially lower rates as investors move money into safer, lower-yielding assets like bonds. Housing. Market activity. The dynamics within the housing market itself can also influence rates, though typically less directly than the broader economic indicators. High demand for mortgages, especially when coupled with limited housing supply, can give lenders more pricing power, putting upward pressure on rates as they find they don't need to offer lower rates to attract borrowers. Conversely, if demand for mortgages softens, inventory levels are high, or there's a general slowdown in home sales, lenders may offer more competitive rates to stimulate business and attract buyers. While less direct than the Fed or inflation, housing market sentiment and supply-demand dynamics play a role in the competitive landscape of mortgage lending. Global events and geopolitical stability. Periods of global uncertainty, political instability, or major international crises can significantly impact investor behavior. When global markets are volatile, investors often seek safe haven assets, such as U.S. Treasury bonds, which are perceived as very secure. This increased demand for treasuries drives up their prices and pushes down their yields. As mortgage rates are tied to these yields, global uncertainty can sometimes lead to a temporary dip in mortgage rates as investors flock to safety. Conversely, a return to stability and reduced global risk might see investors move money out of safe havens and into higher-yielding, riskier assets, causing treasury yields and mortgage rates to rise again. These economic factors are constantly in motion influencing each other and creating the dynamic rate environment we see daily. That's why simply looking at a daily average can be misleading. Understanding the underlying drivers is key to predicting trends and making informed decisions. Borrower-specific factors affecting your rate. While broad economic forces set the general direction of mortgage rates, your individual financial profile plays a crucial role in determining the specific rate you qualify for. Lenders assess your risk as a borrower, and the lower your perceived risk, the better rate they are typically willing to offer. This is where you have direct control. Here are the key borrower-specific factors. Credit score. Your credit score is a numerical representation of your creditworthiness, a 3-digit number that summarizes your payment history and financial habits. A higher FICO score indicates a lower risk to lenders because it shows a history of responsible borrowing and timely payments. Lenders categorize borrowers into risk tiers based on their scores. Borrowers with excellent credit, typically 740 or 760 and above, will qualify for the lowest rates available, while those with lower scores, e.g., in the 600s, will likely face higher interest rates to compensate the lender for the increased risk. Maintaining a strong credit score by paying bills on time, keeping credit utilization low, ideally below 30% of your available credit, and avoiding new credit inquiries or large purchases before applying for a mortgage is paramount. Even small improvements can make a difference in your rate tier. Down payment amount, loan-to-value, LTV ratio. Your down payment significantly impacts your loan-to-value, LTV ratio, which is the loan amount divided by the home's appraised value. A higher down payment means a lower LTV ratio, signaling less risk for the lender. For example, a 20% down payment means an 80% LTV, while a 5% down payment means a 95% LTV. Lenders often offer better interest rates for lower LTVs because they have more equity protecting their investment in case of default. A higher down payment also typically helps you avoid private mortgage insurance, PMI, on conventional loans, further reducing your monthly housing costs. The more skin you have in the game, the less risk the lender perceives. Loan type. As we discussed in our previous session, the type of mortgage loan you choose has its own inherent risk profile for lenders, which directly impacts the rates offered. Conventional loans. Rates are influenced by your credit and LTV, often offer the best rates for highly qualified borrowers with strong financial profiles. FHA loans, because they are government insured and have more flexible credit guidelines and lower down payment requirements. FHA rates can sometimes be slightly higher than conventional rates for top-tier credit borrowers, though their accessibility makes them invaluable for many sans-abri. VA loans. Due to the VA guarantee, these loans often boast some of the lowest interest rates available, recognizing the service and commitment of veterans. They are highly competitive. USDA loans. Also government-backed for eligible rural areas, USDA rates are generally very competitive, offering low rates with zero down payment. Jumbo loans. For loan amounts exceeding conforming limits, rates can vary. Historically, they might have been higher, but in certain market conditions, they can be surprisingly competitive or even lower than conforming rates for highly qualified borrowers with substantial assets, reflecting the strong financial standing of these borrowers. Loan term. 15-year versus 30-year. The length of your mortgage term also influences the rate. Generally, shorter loan terms, like a 15-year fixed-rate mortgage, come with lower interest rates compared to longer terms, like a 30-year fixed-rate mortgage. This is because the lender's risk is lower over a shorter period. There's less debt, time for economic conditions to change, or for you to default. While a 15-year mortgage will have a higher monthly payment, you'll pay significantly less interest over the life of the loan. The choice depends on your budget, your long-term financial goals, and how quickly you want to pay off your home. Debt to income, DTI ratio. Your DTI ratio is the percentage of your gross monthly income that goes toward paying your monthly debt. Payments, including your new mortgage payment, credit cards, auto loans, student loans, etc. Lenders use DTI to assess your ability to manage monthly payments. A lower DTI, e.g. 36% or less, though some programs go higher, indicates less financial strain and a greater capacity to handle your mortgage payments, making you a less risky borrower. A higher DTI might lead to a higher interest rate or even loan denial, as it suggests you might be stretched thin financially. Reducing existing debt before applying for a mortgage can significantly improve your DTI and potentially secure a better rate. Property type and use. The type of property you're buying and how you intend to use it can also affect your rate. Lenders generally consider owner-occupied primary residences to be less risky than investment properties or second homes. Therefore, you'll typically get the best interest rates on a primary residence. Investment properties and second homes carry higher perceived risk for lenders, e.g., higher likelihood of default if the market turns. So they usually come with slightly higher rates and potentially stricter qualification requirements. Even within primary residences, single-family homes often have slightly better rates than condos or multi-unit properties due to perceived differences in risk and market liquidity. Locking your rate. Once you have an accepted offer on a home, you'll have the option to lock your interest rate. This means the lender agrees to honor a specific interest rate for a set period, e.g., 30, 45, or 60 days, while your loan processes. This protects you from rate increases if market rates rise before your closing. However, if rates fall after you lock, you might miss out on a lower rate unless your lender offers a float-down option, which comes with its own terms and fees. Your mortgage professional can advise you on the best time to lock your rate based on market conditions, your closing timeline, and your risk tolerance. How to get the best mortgage rate. Knowing what influences rates is one thing. Actively working to secure the best rate for your situation is another. Here's how you can position yourself to get the most competitive mortgage rate. Boost your credit score. This is often the most impactful step you can take, as it directly influences the risk tier you fall into for lenders. Start by requesting a free copy of your credit report from all 3 major bureaus, Equifax, Experian, TransUnion, to check for any errors that could be dragging your score down. Dispute any inaccuracies immediately. Most importantly, pay all your bills on time, especially credit card and loan payments. Reduce your credit card balances to lower your credit utilization ratio, ideally below 30% of your available credit, even better below 10%. Avoid opening new lines of credit or making large purchases on credit before applying for a mortgage, as these can temporarily lower your score. Even small improvements can move you into a better rate tier, saving you thousands over the life of the loan. Save for a larger down payment. While low down payment options are available and can be excellent for many, putting more money down signals lower risk to the lender and can lead to a better interest rate. Aiming for 20% down on a conventional loan helps you avoid PMI, but even putting 10% or 15% down can result in a better rate than a minimum 3% or 5% down payment. The more equity you have from day one, the more favorable your loan terms are likely to be. This also gives you a larger cushion in case of unexpected life events or market downturns. Shop around and understand the broker advantage. This is absolutely critical. Never settle for the first quote you receive. Different lenders have different appetites for risk, varying pricing structures, and unique loan programs. What one bank considers a higher risk, another might view as a prime borrower. Why a mortgage? Broker is key. This is where working with an independent mortgage broker, like myself, provides a significant advantage. Unlike a loan officer at a specific bank who can only offer that bank's products, a broker has access to dozens, sometimes hundreds, of different lenders. We can compare interest rates, fees, and terms across a wide range of products tailored to your unique financial profile. We do the comparison shopping for you, knowing which lenders are most competitive for your specific situation, e.g., self-employed income nuances, specific property types, or credit challenges. This saves you immense time, stress, and often secures you a rate far better than what you might find by checking just a few banks yourself. We also understand lender overlays, requirements that go beyond the minimum FHA or VA guidelines, and can steer you towards lenders who are the best fit for your specific circumstances. Our goal is to find you the most advantageous loan package, not just get you approved. We are your trusted guide, navigating the market on your behalf. Lower your debt to income, DTI ratio. Before applying, focus on paying down high interest debts, especially credit cards and personal loans. A lower DTI indicates that you have more disposable income available to comfortably cover your mortgage payments, making you a more attractive borrower to lenders and potentially qualifying you for a better rate. Even if you don't pay off debts completely, reducing your minimum monthly payments can improve your DTI. Be prepared with the documentation. Having all your financial documents ready and organized, tax returns for the past 2 years, recent pay stubs, bank statements, W-2s, etc., can significantly speed up the application and underwriting process. Delays can sometimes lead to your rate lock expiring, forcing you to re-lock at a potentially higher rate if market conditions have shifted. A smooth, efficient process keeps your locked rate secure and reduces stress. Discount. Points are an upfront fee you pay to the lender at closing in exchange for a lower interest rate over the life of the loan. 1 point typically costs 1% of the loan amount and reduces the interest rate by a certain fraction, e.g., 0.125% or 0.25%. Whether paying points makes sense depends on how long you plan to stay in the home. If you plan to sell or refinance, within a few years, the savings from the lower rate might not offset the cost of the points. Your mortgage professional can help you calculate the break-even point to determine if buying down the rate is a smart financial move for your specific situation. Monitor market trends, but don't obsess. It's good to have a general awareness of where rates are headed. Read financial news, listen to experts, and understand the basic influences like inflation and Fed policy. However, avoid obsessively tracking daily fluctuations. The market is too volatile for that. Rely on your mortgage professional to advise you on when to lock your rate based on your loan's progress and the prevailing market conditions. They have the tools and expertise to make informed recommendations and help you make a timely decision. Conclusion: mortgage rates, while seemingly complex, are driven by understandable economic forces and personal financial factors. They are not static. They are constantly moving, reflecting the broader economic landscape. Your personal financial health, coupled with market conditions, dictates the specific rate you'll ultimately receive. The key takeaway is empowerment through knowledge and strategic action. By understanding what affects rates, from inflation and Fed policy to your own credit score and down payment, you can position yourself to secure the most competitive financing possible. This is where a dedicated mortgage professional truly shines. My team and I are here to guide you through these intricacies, translating market trends into practical advice, and leveraging our access to multiple lenders to find you the best possible rate and terms. We aim to ensure you understand every aspect of your mortgage, leading to a smooth, confident journey to home ownership. Ready to understand your best rate options and secure a great deal? Contact me for a personalized consultation. Visit my website or call my office directly. Let's secure the best financial foundation for your dream home. Thank you for watching, and I look forward to helping you soon.